It's really nice to see you, Ben. Thank you so much for agreeing to be on our podcast.
I appreciate the opportunity to talk about what Verity does.
Yeah, I'd love to learn more. Why don't we start? I'm curious to hear about your story. What's your who is Ben?
So Verity used to be a company called Insider Score. We merged Insider Score with Mackie RMS in 2020. And Insider Score started in 2004, and I've been here since the beginning. Director of Research, now VP of Research. So now it's been over 20 years. And prior to that, I worked in the company that became Insider Score. We actually did investment newsletters. So I wrote those. And we actually did, it was kind of interesting because we did it, there's so many investment newsletters 20 years ago, people trying to make money off of investors, retail investors. We ran it like a hedge fund. We actually audited our returns, things like that. So it's pretty cool. And then the guy who ran that ended up launching a successful hedge fund. And so that was interesting. Before that, I came to all of this because I was a business journalist. So I was a victim or what's the opposite of a victim? I was a beneficiary of the dot-com boom and bust. So I worked for dot-coms, and then I started a news service where I was tracking layoffs and company blow-ups and M&A and things like that. And I was using a tool called UPOC that existed before Twitter did. And it was the same kind of concept, and I started it on that, and then did it as like a blog and a newsletter. And then I wrote for the New York Post for about 3 or 4 years, or had a column. And then I did a lot of reporting on, media, tech, and telecom. And so this was in the 2001 to 2004 time period. So it was an interesting period back then.
Did you read the news as a kid, or did you have like a paper route? How did you get into the news business?
Yeah, so I grew up in the Washington D.C. area, and we had a subscription in the Washington Post, read that every day. My dad ran a construction business, but he had been an econ major in college, and he was really into the news and investing and things like that. So we had a subscription to the Wall Street Journal. And so, when I was a kid, not like fervently reading it, but, my dad taught me about stocks. My grandfather was a stockbroker for Paine Webber back in the day, if anybody remembers that. And then when I was in high school, I wanted to be a journalist. I was like the sports editor of my newspaper. I wrote for some local newspapers and, things like that. So sort of always had that. It would call it a journalism bug, but it really morphed into a research bug. It's trying to uncover things. And that's when I was a journalist. I loved breaking stories. And then I did it often using, data. And, we used to call it computer assisted reporting and then data driven. And so I would, whether it was, that's how I got into the tracking insider trading, was before there was a lot of available data, digging up those documents, trying to piece data together, going through the Southern District Court of New York bankruptcy website back in the day. Again, this is 25 years ago, but when dot-coms were going out of business left and right. And, the first way to find out about it and who they owed money to and things like that was to, go through this very, very rickety bankruptcy court website. I'd say I've spent about last 25, 30 years of researching and writing and, again, using data to basically drive all of that, everything I do.
Was that pretty uncommon back then to be a data-driven journalist? Seems like even today it's quite novel, but for 25 years ago, it must have been pretty unique.
It was definitely, it was an independent journalist for a while, meaning that I had a blog, this is in early days of really self-publishing online. So I had what we would call, I guess, a blog back then. And, not many people were doing it. And that's how I broke stories. That's how I was sort of unique in the marketplace of ideas then, is because I was young. A lot of the financial reporters at the time were older. It's just, that's to become a financial reporter back then, you put in some sort of time in the coal mines, sort of to say. And so I just, was really up on, the current technology at the time and really understanding how to use the web to find, things, but also how to tap into early social networking to get sources, and those sources would give me data. if, here's something going on at a company and I'm going to give you a spreadsheet and, you're going to have to figure out how to, wring a story out of it by using that data. So yeah, it's pretty interesting.
How do you combine that side of it as well in terms of the people side, talking to sources and using sources to then give you data and then look at the data, but then going back and forth, I'd imagine, with the sources or other experts to try to understand what's going on. It's sort of this human plus data component to it.
Well, I mean, the human component to data is so important, in my opinion, because first of all, if you were in my position as a journalist, I was relying on people to help me interpret the data. People would give me data. I'm not an expert in everything, obviously. Nobody is. And you need, that element, whether it's a written key or having a conversation. Hey, help me. I mean, and I still do this today. I speak with journalists all the time, and that's part of my job is to help them understand how the data works and what it means. And then, really the other thing about that is not just getting that understanding, is understanding what the limitations of the data, because data tells a lot of stories and it can drive a lot of good decision making and also drive a lot of bad decision making. And if you don't if you don't have these reference points from experts on it, I think that there's, a tendency to make a lot of mistakes in how you utilize data.
Are there any stories that come to mind about talking to some experts that really help clarify things or help avoid you making a mistake?
So I covered very closely the WorldCom accounting scandal. Again, this is, I think, 2002, 2003. And I wrote between my website and newsletter and the newspaper, I probably wrote 500 stories covering this thing over the course of a year. Some of them small, some of them were, bigger enterprise type things. And, I would get data from internal sources. And, it's telecom related, financial data, which is not something I had a background, and, even reading a 10K, for a telecom, at the time was, there's all kinds of terminology and accounting methodology that they're using that I wasn't familiar with. And so I got very lucky. I had a couple of very veteran reporters who had deep contacts, and they turned me on to some forensic accountants. And those people are about some of the smartest people you'll ever meet when it comes to like investigating data, understanding what it means, understanding whether it's true, and understanding where it's not true. And so it really helped me understand that what I was looking at in terms of, on paper, or on my screen wasn't always the full story. It helped me understand to look for outliers, more to, and to question outliers as well, and not just, accept these things, to be true or accept them to be rational. So yeah, I would say, talking to some forensic accountants over the years when I was a journalist really helped shape my own research and data usage methodology.
For those who don't know, what was the WorldCom accounting scandal story?
Gosh, I'm trying to remember the specifics at this point. So WorldCom was a giant telecom, they back then, some of the big money was being made in things like what they called backhauling, which was we had telephone networks that were important, and you had local exchanges, and basically when a phone call left the local area and traveled across telephone lines across the country or overseas, as a consumer or as a business, you had to pay for that. When I was a kid, you actually literally you paid by the minute. If you made, young people that will probably think we're insane talking about this, but I was a kid, you had to pay for long distance by the minute, and the rates were different on nights and weekends. If, I grew up in the Washington, D.C. area, and say I wanted to call a relative in Florida, we would wait until after 6 p.m. or we would wait until Sunday morning because, you got charged by the minute. So WorldCom, big part of their business was things like backhaul, what they called backhauling, which was moving that traffic along. And they also had wireless components, all this other stuff. And essentially their whole accounting was just like a house of cards. They had lied about the numbers and, inflated revenues, inflated profits. They were doing all kinds of, book hooking type things where they were hiding losses and hiding some capital expenditures, things like that. And it was really interesting about it as somebody covering the space is when I start talking to people at other companies, this was back in the, nowadays local telephone companies really don't exist or don't matter. But then you had several major, companies, Verizon, which now is Verizon Wireless, AT&T, Bell South, SBC, companies like this. The effect it had on the industry was so big because if you're sitting there and you're running a public company and your competitors are putting out all this fake data and saying, we're doing this, well, your investors are holding you to that, on a relative basis, their peers. And so what was really interesting about that whole thing was how many people told me, whether it was senior executives or regional salespeople, they were getting benchmarks set to their peers that were fake. And so their own compensation committees and their own internal, comp type things, and their bosses were using bad data to set goals internally because they were using some data that came from a competitor that was lying about it. So it's really, really interesting to sort of see that unfold and talk to people and start to understand, in that case, this one company could really have a ripple effect on how other people were doing business, all because they were lying and, again, issuing fake data.
I never considered these second order effects of fraud because you always look at it from the perspective of it's harming your shareholders or people who gave you money. But exactly to your point, it's also like everything is relative and they could harm a random employee from a competing company who's didn't perform as well relative to this fraudulent company, but it was really all fake. That's fascinating.
Yeah, it was. I mean, I remember this one guy, and he was in Florida, and he worked for Bell South, and this is so long ago. I'm not going to expose anything. He was like, I mean, he was sending me stuff. He was saying, communication saying, that we're benchmarking things to some of the things WorldCom was publicly saying before, the fraud was exposed. And he was like, this affects my family, this affects my livelihood. And, it's stressful, and then I find out it's all fraud. And you're just like, I'm chasing something that didn't exist. And, everybody's like, we had these unreasonable assumptions, and it just really, it's very hurtful, from a personal point of view for, when you find this stuff out, because you're like, everything I was doing was based on lies. And, the people telling me to do these things, they didn't know it was lies either. So that's that secondary effect. It's bad enough to have worked at a company where, your senior management's lying to you. But then to find that you work for a company where your senior management, they're not lying to you. They're just basing decisions on lies, that they've been told. So, yeah, it's very interesting.
Do you think this is one of the themes in your career is trying to figure out when people are lying? And what have you found out about identifying when people lie?
Yeah, I mean, it's my team, and we've worked together for a long time. It's mostly former journalists, and we're all former financial journalists. And we got into this because we like sort of researching, we like uncovering the truth. So we spend out, we do a lot of, we track insider trading. So this is corporate executives and board members buying and selling shares of their own company, right? And we do a lot of behavioral analysis, and our clients, institutional investors coming to us and saying, what do you think it means? Right? What do you think it means? And, they'll often come to us and say, well, I talked to management and they said this, but you're telling me this. And I said, well, do you trust management? They say, well, no, not really. And I said, do you trust us? And they say, yes. And I said, well, I think we're on a good path here, because if you don't trust somebody and you have a third party that you trust telling you, I never call, I'm not going to call someone a liar, but I'm going to say I don't agree, with, what they're saying. And this pops up all the time. Sometimes it's really minor things, and sometimes it's big things, and it'll come from the executives themselves or investor relations, and it's this thing where it's like, well, my data says this, for example, and, I'm going to go with my data over what they say because the data sometimes doesn't lie. So
How do you think about trust? And as a journalist, but also now at Verity, and you talked about how clients trust you over management, but it's not easy, right? How do you actually build that trust?
For us, the biggest thing is, we've always told people, look, we're a third party. We don't I don't work with the companies that I cover. I don't even talk. I try not to talk to them. Let's put it that way. In the early days, I would get solicitations from investor relations, public relations people saying, "Hey, did you see so, our CEO bought a bunch of stock. Can you issue research on it?" And it's like, no, we have an analytical, protocol that we do, that we utilize, and, we make those decisions. We're data driven, right? So we're using our databases, and we're using these histories and what we understand about human behavior and sort of, insider behavior, because their insiders are a market participant and they have a specific set of behaviors that have emerged over the years. And, so I trust that. So for our clients, that's what we talk about, because we don't want to be biased by something the company says. Same token, I don't want to be biased by what our clients say. I'm not here to do bias confirmation for our clients. I think you can, in the research sphere, not so much in the data sphere, but in the research sphere, you could certainly make money doing bias confirmation. I think you can make more money by just being honest and, helping people, and I like when a client says, I disagree with you, because that means I'm bringing a different viewpoint to them. And it's fine if they agree with me, but I like having conversations where we disagree about somebody's intent, or, again, it could be the data itself, because at least there's, an intellectual ability to sort of get to the bottom of something and, potentially bring new ideas. So I think, for us, building trust is really imperative, and that goes to the research we put out, but more so to the data, because, again, it's easy to have a conversation with somebody and take their input. And if you don't trust the conversation, you just move on. If you don't trust the data you're buying from somebody and you're using as part of your, investment process, you're not going to gain that trust back from anybody. I'm not going to gain that trust back from a customer. So they have to trust our data, and, they have to trust us that we're trying to steer them, help them make good decisions. But again, do it in a way where we're coming at it just straight down the middle and independently without a bias.
How do you think about how do you think about trust versus, from a journalism standpoint, things that are sensational that end up being very clickbaity? And especially as an early blogger, you've written about all these topics. And I would imagine that, yeah, sometimes the more sensational the story is, the better it sells, but that's not always the truth. Or there's now an incentive to sensationalize things just so you can get more eyeballs. I mean, I'm curious how you view that side of business journalism in particular.
Yeah, I mean, look, I wrote for the New York Post, and the sensational is what they were all about. You know, I like to say that I wrote for them, but I didn't work for them, which is true. I was never a full-time employee, but I did, wrote for them for a number of years. It was a good, I will defend myself saying it was a good outlet. I mean, I broke a lot of stories that I felt were important, and I never had an editor, ever say to me, don't do this, don't say this, that kind of thing. Look, I mean, as things have evolved, through the years, in terms of what we call media or social networks, or just the way information is delivered and passed through, people, increasingly, and it's obviously been going on for years, they're looking at the headlines and not much else, right? And so that's that's a real problem. And when it comes to financial journalism, and it comes to, headlines can move markets. We see it all the time, and that can make people money. It can lose people money. And, it's, as sort of 50 years old, so I'm an older person sometimes, I have a real problem with that, because, I'm trying to help people make good decisions. And if the people that they're in the market with are making bad decisions based on headlines or based on bad data, it makes my job more difficult. Sometimes it provides opportunity as well. There's a good example recently with Palantir Technologies, which has been in the news a ton. Sort of the CIA of Silicon Valley is sort of one way to sort of look at them, I think. And so there was two things that happened on the same day. There was things going on with Doge and saying that they wanted to cut Pentagon spending, which would impact potentially companies like Palantir. And then the CEO had made a disclosure that he had canceled a Rule 10b5-1 plan, and the Rule 10b5-1 plan is a trading plan that insiders utilize to buy or sell stock, and he had canceled the plan and adopted a new plan. There was these headlines coming out. The stock was falling, I think 7-8% kind of thing. And they were tying the two things together, but they weren't. And so I was sort of battling the headline with my clients because I was getting questions from them. Right. And it's a data point. It's a disclosure in a SEC filing, and we scrape that data and that goes into data feeds and things like that. And it's like a data point. And, we get these headlines, and the headlines are suggesting the stock is moving partly based on this piece of information that's sort of within our realm. So I just sort of battled that. And then a couple weeks later, there's more headlines saying the CEO sold $45 million in stock since this happened. But it wasn't true. One person wrote that, and they missed, and again, this is where the data integrity really comes in. They missed the fact that the sales that they were talking about were non-discretionary sales, tax related to cover the tax withholding on restricted stock vesting. They weren't unusual. They didn't generate cash for the guy. Again, they were non-discretionary, right? So it said it literally on the disclosure of Form 4 is an SEC filing that discloses an insider trade. And there's a footnote on there. And it said it's a non-discretionary transaction. And so I said, why, I was a journalist. Wow, I would never write this story. I would never write a story saying this guy sold $45 million in stock since X date, government spending cuts were announced kind of thing, and tie it together, because it wasn't true. It just, and again, so the guy's utilizing data, but he's not looking beyond the data. And one of the tenets of what we do, and I used to have it up, sort of commandments, was footnotes are there for a reason. And anybody who's worked with big data sets, and they get the information that goes along with it, how are you going to use it, they know you got to read the footnotes. You got to read everything in there to understand the limitations and the use cases for the data. And if there's footnotes and you're not paying attention to it, you're going to miss something super important.
Who would have thought, looking into the details and actually understanding something can make a big difference in it.
Yeah, gathering information and properly analyzing it to then make a decision whether to do an action like write a news story. It's not like that didn't happen in the past. I think we're seeing that it'll continue to increase, and it's causes problems.
Yeah, and I think it's also something that happens a lot in the data world, because people assume you're a data nerd, you're just looking at patterns in data. But the reality, at least for us, is that you need to understand it. You need to do fundamental research on this data and understand how is it generated. What are the implications of outliers? What are the biases? How can they possibly go wrong? And so there's a lot more that goes into understanding data than just finding interesting correlations in it. And that speaks to that.
Yeah, I mean, the biggest, we look at a lot of academic research, right? There's been, the data sets we deal with, specifically like insider trading, there's been a decent amount of academic research over the years, right? And, so we've got 25, 30 years of academic research available through services like SSRN and things like that. And when I started looking into that years ago, and I created like a template internally, how do we review these academic, papers, right? And so we're going to use a template. And at the very top is data set construction. Because if I read how the data set is constructed and there's a problem with it, and I've seen a lot of problems with data set construction in our realm over the years, I'd move on. There's no point for me to look at it. Because if the data set isn't constructed properly and people are making bad assumptions and constructing data sets that way, I mean, what is the point? And it's been a little mind-boggling because I don't have a strong academic background. I didn't go to Harvard. I didn't go to any good college. Let's put it that way. It boggles my mind that I have people, a lot of them are grad students, but some of them are professors, constructing the data sets in ways that are just so far off of the axis of like how you would do this. I saw somebody who, even though there was information for them that they could have parsed and used that data set, they made assumptions and tried to basically create rules to construct their own data set to mimic a data set that already existed. And so it was really far off, because I did a little back testing on it, and I was like, this is ridiculous. Everything they wrote in their 50-page paper was just garbage. So yeah, I mean, you got to know how to construct the data sets, and then as somebody using them, you've got to understand whether the data set, is constructed properly. And again, that's a big deal. And I think a lot of people gloss that over.
It goes back to common sense and applying what's happening in the data to the real world. Asking yourself, does that actually make sense? Why or do we see these types of relationships? What relationship would I have expected to see? And just bringing it back to something that actually tying it back to the thing you're ultimately trying to measure, as opposed to looking at it as a purely academic signal and not understanding that kind of context.
Yeah, I think I mean, I know, quants, pure quants will, use data one way, fundamentals another, and then, a lot of our, non, quant clients, are always trying to figure out how do I intersect sort of alternative data with my own fundamental data, and, wring something out of it. And, I think people who jump into something without understanding it are really in danger of overutilizing something, and obviously not in a beneficial way. And we've seen that, and we work closely with our clients to try to guide them, how to use it. And it doesn't matter whether it's a quant or whether it's a PM at a fundamental hedge fund. We want to make sure, if they want the guidance, we can give them as much guidance as possible, and so that they get, real value out of it. Obviously, from a business perspective, it's smart because we want them to be customers for a long time and repeat customers. But, from an intellectual point of view, I just, I don't like the idea of somebody not having information that I have that can help them.
Well, I want that information. So it's a good segue to tell me more about how you guys collect this data and how you see it used.
Yeah, so at Verity, we have several data sets, and we collect all of our data collection comes directly from SEC filings. SEC filings are publicly available. It's a highly commoditized source for information. Any fundamental data that people are seeing, about public companies is coming from the SEC filings if it's a U.S. company, because that's where all their, that's where cash flow table and balance sheet tables are all coming from the filings. And so one of the reasons we started in Insider Score 20 something years ago was that the SEC had mandated digitizing insider trading disclosures, which had previously not been digitized. So they were literally on paper sent to the SEC, headquarters in DC. And so we said, okay, there's an opportunity here, because we knew fundamental data was going to be, commoditized, and there was well, you weren't going to be able to charge for it unless you layered on analytics, which were few and far between, 20 years ago in that space in terms of, what was available out there. So, we said, let's collect this data and start analyzing it. And, as the years went on and, we have more and more data, we can do back testing and other things with it, create, events, what we call unusual events around it. Well, what other data sets can we do this with, that are from these SEC filings? So we started getting buyback information. We started getting at the market offering information, which people are unfamiliar with that. So at the market offerings is a way for companies to raise capital by selling stock, but not doing so through a secondary offering. So there's a lot less paperwork involved, and it's sort of like a broker assisted sale of stock, where they're just say, hey, we want to raise, $15 million. It was largely used by development stage biotech and biopharmaceutical companies for years, for REITs as part of their cash flow generation thing. But then sort of around the time of the pandemic, we started seeing technology companies and more like E&P companies, oil and gas, use it. So ATMs, we started doing management change, which is data, but it's a piece of data. It's interesting because it's sort of narrative data, but at the end of the day, you get data points out of it. When there's changes in the C-level or on the board level at companies. So our whole thing has been, how can we wrench information out of SEC filings that other people aren't doing or that is being underutilized. And so that's, we started with the insider trading and we've just branched out into a lot of different fields like compensation is a big, executive compensation is now a big field for us. And there's been data on that for years, but it's a really difficult, the way it's disclosed, it's really difficult to sort of wrench the data out of there. And, so we've worked really hard to get that and make it in a way that is more data driven than the other offerings out there, which are sort of more around governance. And, while our clients utilize this management comp and incentive comp data for those kind of things, there's also some more sort of quantitative aspects to it, as well that can be used.
What are some of the more interesting stories that you've come across in terms of executive compensation?
Well, there's a lot of things sort of thematically going on right now. So one of the things we're seeing, when there's a corrective action in the market, as we're seeing the moment, which is early March 2025, where we see changes in comp structure sometimes. So there's a fair amount of companies that's, the market was doing good in Q4 of 2024. In certain spaces, stocks started to come down. And Q1 is the time when most companies, when most boards make their compensation decisions. Not just how much are executives being compensated, how are they being compensated? So, for example, we've seen a number of companies where they have stock options have historically been part of their compensation mix. But because the stock is down over the past few years and all the options are underwater, they've taken them out of the mix this year. And they're doing that because if you're an executive and, like, man, I got 3 years where half of my stock-based compensation is currently worthless, you might want to go somewhere else at that point. So one way to incentivize people is change the compensation mix and give them restricted stock, which is $0 cost basis. I mean, it could be worth less than, what it invests eventually. It could be worth less than it was at the time of the award, of course, but it's not going to be worth zero unless the company goes bankrupt. Whereas a stock option could still be in the money, but if you're only getting a 3% gain on it after taxes, you're not getting anything out of it, kind of thing. So we're seeing changes in compensation mix on that side, but we're also seeing other changes where we're seeing an increase in companies benchmarking some executive comp, especially with CEOs, to actual stock price achievements. So, historically, there's been a lot of different ways to incentivize executives, both in cash and stock, and to use, very traditional fundamental aspects of it, whether it's, depending on the company, it could be, some type of CAGR, methodology or calculation. It could be, net sales. It could be earnings, obviously. The companies moved away from using earnings because a lot of investors suspected that, management teams were doing things to goose earnings to get their compensation to, and then we see a lot of things like relative TSR, so relative total shareholder return use. Now we're seeing a little more in the mix of, you get the stock price moving. I don't care how you do it, because we're going to give you a stock award and we want 100% appreciation from the current stock price, 30, at least for a 30-day closing period within the next 5 years. And if you do that, you'll hit your threshold. Now, if you get the stock up 200%, this award will double, right? So, we're seeing that more. And so, we're scraping that data, and, that goes into, part of our data feeds and our databases. And that, when you have like actual finite valuations that need to be hit, that can be a really powerful tool for you to utilize, and the same goes for stock option grants, as we collect all of that data and, we utilize that. And so, I know some of the clients that, that I've dealt with, they'll utilize that as, they, however they want to label that column, they do it. I know one client I spoke to, they have a section called aspirational pricing. And so that's stock options, but they'll take the stock option strike prices that the executives are given, and they'll look at, that aspirational pricing will be that strike price plus X%, because, they want to understand, where does this team need to get this stock to really get rich, right? And so, so that, That's one way that clients and investors can utilize that. And it's a really important thing when you think about, at the end of the day, if you're an investor, you care about stock prices. That's what you care about. You want the stock to go up. You also want to understand what are the levers to get the stock. There's a lot of fundamental levers, there's a lot of macro levers, there's regulatory and legal levers, and things like that. And then there's there's a very human aspect of how are the people running the business incentivized to start pulling levers. And if you understand the key prices for those executives, then you're going to start to understand part of their why they're making the decisions they are. And you can also, again, you can put that up against, other fundamental data, whether it's earnings growth, sales, margins, things like that. Because you start to understand, what matters to them. Is it margins that matter to them? Is it sales growth? Is it, some of these other things? And we'll see more of that because with the sort of the current climate and movement away from things like, DEI is dead, ESG is sort of part of ESG, and you're going to, I think you're going to see less comp pegged to these qualitative things that are out there in the kind of sort of compensation sphere, and just more of a movement towards just more absolutes. Get the stock price moving. That's all we care about. Because if the stock price is moving, then our investors will consider this success, right? And then you'll be rewarded.
That's fascinating. I did not realize that these compensation benchmarks are changing, and it also highlights how hard it is to measure something, and where there are a lot of different ways to measure the same thing, and depending on how you do it, you end up with very different incentives. But I do wonder though, if you move the CEO compensation to be tied to stock price, if all of a sudden they sound super cheery on earnings calls, and if you look at like sentiment scores across this, like everything is awesome, going to the moon, but they just, in some ways, you almost like incentivize them to become salespeople for the stock, and not just like, let's judge it based on its merits, but you now want to be a cheerleader for your company as well.
And there's so many different types of CEOs, right? And there's people who, pretty transparently cheerleaders for the stock, and if there's companies out there, and if, people who follow those companies for years sort of understand that. There's been companies for years that, lowball estimates, under promise, over deliver. And then when you see them do it 8 quarters in a row, you're like, well, I can, it's a dangerous game, because you start to pick up on that behavior, and you say, okay, well, here's what they're saying, but I know that they're always coming in on an average 8% above this. So I'm really going to factor in that 8%. So the minute they miss, they're in trouble, right? And then there's people who talk about, hey, I'm running a business for the long term. I do care about stock price, but it's not the most important thing. I care about my stakeholders. I care about, everybody involved in the, with this company, whether it's an employee, whether, it's a bondholder, whether it's our customers. And so that's, again, that human element of, when you're looking at data, what do I know about this person and how they manage a business? And again, how are they incentivized? But also, what do they say? And do I believe it? There's a lot of, you had mentioned, do they become cheerleaders, and do the sentiment scores sort of go off the chart, right? So one thing we do is that we got into a couple of years ago is earnings call transcript analysis using AI. So we created our own, what the word is, prompts. So we spent a lot of time working on prompts, and people can, you could go to ChatGPT and write a prompt and say, analyze this like you're a sell-side analyst, right? But, we obviously did a lot deeper than that, utilizing our deep background and our history. Problem is, it's words on paper, right? You can't, we can use vocabulary. You can use AI and tell AI to look for certain vocabularies, certain words that are used, but we're not using audio recording. Some people are, to try to get tone. But at the end of the day, there's a very human element to that. And that human element is, if you're a sell-side analyst, it is very rare for you to get on an earnings call and to be combative with management. Because if you're combative with management, you are no longer going to have access to management. So what is said on a call that is publicly available is much different than the tone that might be struck on a call that nobody is privy to because it's private. And so when we talk about things like sentiment analysis and, employing AI, there are limitations to it. But, you can start narrow things down again with the verbiage that's used. We've started looking into things, even how like questions are ordered, because, you go the way conference calls work is you go into a queue to ask a question quite often. Well, if you're running that call, if you're the IR person who's running the call, you know who your friendliest analysts are. And you're going to front load those questions and keep those questions. You try to keep the questions from your friendliest analysts up top, because that's who you want to get the call off to. Start the call off and, start talking about it. And again, those all become data points. That all becomes, you could boil that all down to data, whether it's sentiment scoring or whether it's, things like, where there's sort of combative exchanges, or, things like that. So it's pretty interesting.
It goes back to your earlier point about understanding how this data was generating, and in particular the incentives of the people involved. If you just go read an earnings transcript without realizing that, hey, it's the IR person that manages the queue, then you wouldn't be able to pick up on the fact that, yeah, like they're clearly the IR person is incentivized to make this sound really good. And yeah, you're not going to take hard questions from people who don't like you. You're going to put those towards the end, or to your point, might not even invite them at all. So there's this inherent bias that the people on the call are going to be people that are going to be somewhat friendly to the company, and that it goes, yeah, in any data set, you're going to have biases. And if you understand how it was generated, you can start to get at some of these questions and address some of those issues.
Yeah. I mean, one of the things that we talk about internally and with our clients is what is missing, right? And so context is often missing from data, but also it's action and the absence of action. So like, for example, one of the things that has happened with insider trading over the years is because there's been so many changes in the way executives are compensated. If I go back 30 years, so before the dot-com boom, executive compensation was some very boring stuff. Stock options were used, but the size of the awards, if were not anywhere close to what they are today, even inflation adjusted, and even adjusting for things like market cap, right? And then you have the dot-com boom, and you have, how do we pay these people when we're not making money? I just give them a bunch of stock options, right? And so it just snowballed from there. And then you use so much stock-based comp. Well, stock-based comp affects what you do with your own money. So if I'm getting an enormous amount of free stock every year, whether it's $0 cost basis restricted stock, whether it's stock options, I have no incentive to ever buy a share of my company's stock. I mean, why? What's the point? I'm getting free stock every year. I could sit there and accumulate millions or hundreds of millions of dollars, depending on the person in the company, of stock in years. Why write a check out of my own pocket and buy stock? So, and that's what happened a lot in S&P 500 companies. Over the years, you see less buying instead of buying. And so how do you get a positive signal out of people who aren't buying stock and are more often than not actually selling stock? And so, we keyed in on, well, what happens when they stop selling stock? Is that a signal? And so we call it a cessation of selling. And we said, we started looking at it and we said, well, we've got all this insider trading data. So we know the cadence of when they sell stock. We know on a company level and on an individual level and then a company level, we know when these people are selling, we know how much they're selling, we know what type of selling they're doing, whether they're using trading plans or they're using stock options, whatever it may be. And so, he said, well, let's look at what happens when they stop selling. What does this mean? Because it's a human behavior. You're generating liquidity on a regular basis, or you have a group of people generating liquidity on a regular basis and they stop. Why are they suddenly stopping? So, for example, if I look at a 4-year period for any company, and there's 16 quarters in 4 years, we look at a lot of the insider trading stuff on a quarterly basis because of companies have trading windows every quarter. So there's periods every quarter where the insiders are not allowed to trade. And so we need to, account for that. So we look at things on a quarterly basis. So if they've sold in 16 out of 16 quarters, and then now we hit quarter 17 and they stop selling, why is that? And so, what we found is there's 2 reasons that it happens. there's probably more than two, but there's two that we've identified as being potentially meaningful. One is they stop selling because they think the valuation's wrong. So this is often in cases where the stock is dropped and they say, I'm unwilling to sell here. I could sell here. I've got my restricted stock vesting, and the stock didn't cost me anything. Stock's down 25%, from, the high from 3 months ago. I don't think this is where the stock should be valued. I'm not going to sell. I know I'm going to have other opportunities. Again, I'm a unique market participant who didn't buy the stock. So I'm not a retail investor trying to build my nest egg or do a good trade. I'm not a hedge fund trying to generate alpha. I don't care. I'm willing to not sell the stock here, change my behavior. So that's one thing we identified. And then the other is, well, maybe there's something else behavior going on. Maybe they've all of a sudden been told they can't sell stock. And what does that mean? So we've seen these change in insider behavior, these stoppages in selling, almost like the data stops. As we've seen it can sometimes be a precursor to M&A because there's a material event that is in the works and the insiders, the executives know this and they've been told, hey, can't do anything with the stock until, this plays out. We're in negotiations right now. So we saw that, the deal didn't go through, but that happened at Kroger, the grocery store operator, when Albertsons was going to buy them I think it was about 3 weeks before the deal was announced, and there weren't really any rumors in the marketplace about it. We noticed because we've engineered an event to identify this. Hey, they stopped selling at Kroger. What's going on here? Why do they suddenly stop selling? And we formed our clients about it, and some of them made some money by recognizing that they took their own knowledge of the space, their own fundamental research, their own understanding of regulatory frameworks, things like that. And they said, hey, wait a minute. I already thought this was ripe for consolidation. Now I'm getting this data point that is, potentially pointing to, one of the, a company in this space, the insiders suddenly stopped selling for no apparent reason. Because, for example, the stock wasn't down there. It wasn't like there was some valuation disconnect, perception, potentially going.
And I would imagine this is across most people, most insiders in the company, right? So that's another way to look at it. It's not just the CEO or one person stops selling, but it's everybody, which should indicate it's a company level thing that's happening. It's not just some idiosyncratic performance based on that insider.
Yeah. So we look at cessation on a company level because that's, as we tested, we do pinpoint one insider for our cessation selling event. We use the entire company. And there's some also qualitative things that go into it. The data, we wrote algorithms to identify this and the testing on it, but not everyone's a winner, obviously, so we have to also take a qualitative look at it and say, well, I don't think this is that meaningful, but a lot of them are. But on the individual level, there's things that pop up all the time that, that we can identify again through the data, through, for example, the cadence of selling or through how many shares they sell in a given transaction, right? Is a simple thing. And so I had mentioned Palantir, and one of the things at Palantir was that the CEO had been selling a lot of stock, but a lot of stock, but the stock was doing so well that it didn't matter. It's like, his holdings blew up in terms of the value of them. So the dollar value of his exposure to the stock, even after selling like $1 billion of stock, was like 10 times higher than when he had started selling. So it's kind of like, well, yeah, I mean, he's just kind of doing some financial magic there. But he stopped selling, and this was like an opposite thing. He stopped selling because he didn't want to keep selling at a price. This is our opinion based on his behavior. Was we felt he stopped selling because he didn't want to sell at prices that he thought were low. He thought the stock was going to continue moving higher. And so he decided, hey, I'm going to kill my plan here, this trading plan in effect, and I'm going to adopt a new plan because I actually think the stock's going to move higher. And what I don't want to happen is for me to continue selling at prices that I don't feel recognize, the value, that I think the stock should be at. So you could get a lot of different signals, both on the company level at an individual level. And we'd seen that Tableau was a company that, eventually got acquired by, when I say Oracle.
It was Salesforce.
I can't remember. It's Salesforce, yeah. Salesforce or Oracle. I should know this. should remember this because Tableau was based out of Seattle, and their headquarters could look out my window and see their headquarters. But Tableau, they had several of the insiders there were selling a lot of stock on a regular basis. There's two key insiders who were two of the founders, and they stopped suddenly. And like 4 months later, the Salesforce acquisition got announced. And so it's just like, hey, these guys, they were smart. Like, why keep selling stock? If you're going to enter in negotiations to sell the company, and if the company doesn't get sold, you start selling stock again. Who cares? You missed 4 months. Again, you've got a ton of stock. You're an insider. You didn't buy the stock, so you're willing to go to the sidelines. And again, that's the thing, is they're willing to go to the sidelines. And when they start doing that, and the data starts showing, there's been a change in this behavior, that's when our radar lights up.
I love it. I think one of the goals for this conversation is for us to come up with a New York Post style headline for it to make it sound more sensational. I feel like we're onto something, something like that. The top 10 companies about to merge. You won't believe number 4.
Right. Well, if you're into the New York Post style headline, their most famous headline is a headless body found in topless bar. And this is some horrible incident from like 40 years ago where somebody got decapitated in a strip club.
I love it. I did not know about that one. That's great. That's great.
That was great. I'll tell you you edit this, correct?
Yeah. But this might be the best part.
I wrote a story on the NHL, right? So there was talk of a player strike or a lockout or something. So I did the story, and I talked to the commissioner of the NHL at the time, talked to the head of the players union. Hey, there might be a player strike or a lockout or whatever. And the headline was, "Get out the Zambonis, NHL may be pucked."
That's so good.
No, I didn't write the headline, because that's the cop editors do. But I love that one.
That's so good. Well,
I had a story. The headline was .com perverts. So that, and then when it did follow ups, it was like .com perverts strike again, or .com perverts arrested. It was like crazy.
That's great. Well, we got to come up with a good one for this episode.
Data perverts, or no, I'm just kidding. That's weird, but that might resonate in some circles. Who knows?
So what else do you guys see? What are some of the other big wins or case studies that you can point to that your customers have gotten a bunch of value?
Boy, see, now you're making me work hard. No,
you know what?
I mean, we have a lot of winners. Well, not everything we do is a winner. I would say this. We don't. Our job is not to give stock picks, which is nice. That's a difficult business. Our job is to help our clients as part of their investment mosaic to make better decisions with our inputs. We do talk about when we're convicted on ideas and things like that, because hey, somebody's got a great history. A good example actually is Tesla. What's interesting about Tesla is that Elon Musk had been a buyer several times. This is going back about 10, 15 years. He hasn't bought a long time. One of the things we looked at was, well, is he picking good prices, or could you just buy Tesla at any time and do as well as he did? We actually found out that he wasn't picking good prices at the time. So his buys weren't beating the stock's own performance. He happened to just kind of buy at times where his returns would trail a little bit if you'd bought a week or earlier, a week later, right? So then at a couple of years ago, I think it was the end of 2023, he sold a bunch of stock. He said he was going to do it, and he said why, this and that. What was interesting was his brother, Kimball, who's on the board, also took that opportunity to sell some stock. The thing we had identified with Kimball is that a certain type of his selling was meaningful. So he had used Rule 10b5-1 plans to get trading plans. So you adopt these plans, and you can structure many ways: sell at a predetermined price, sell once a month, sell once a week, sell every day. You could use more complicated formulas. If the 30-day average close hits this, sell 500,000 shares, whatever it may be. So he had utilized Rule 10b5-1 plans off and on over the years, and he had captured good prices at the sales. He'd sell and the stock would go up, so, it didn't matter. What we found out was when he didn't use those plans, when the trading window was open and Kimball Musk said, I'm going to sell some stock right now and I'm not going to use the Rule 10b5-1 plan, those sales were very predictive. Those sales where he was hitting highs, and then not just highs, he was hitting inflection points where the stock was coming down pretty dramatically afterwards. Back in 2023, when Elon Musk was selling a lot of stock, and, he's, in the news talking about it. Hey, I'm selling for this reason. And he's like, I think he might have been selling to generate some of the money to buy Twitter. And he had some tax things going on because he had these giant option awards. Well, then he said, hey, look, it's up to you. Do you believe Elon? What do you trust? What do you trust? Do you believe what he's saying or whatever? And then Kimball shows up and said, no, this is bad. This is bad. So, we have what we call actionable briefs, and we issued a research brief for our clients, and we said, hey, this is bad because this guy's got a really strong history of calling inflections for the stock. So he sells, sure enough, turned out to be like a really good winning trade. I remember talking to some clients about it. Then he sells again. So Kimball does the same thing at I can't remember, it's at the end of 2024, so just, recently. And he said, well, I think if you were betting against Tesla at the moment, so this is actually before the inauguration, but it's like, well, I don't know. Tesla's going to probably be pretty good at it, but like, this guy knows the stock. He really knows the stock. So we warned our clients when we said, hey, this guy's got this history. And again, I mean, it's all based on the data. It's behavioral, but we get the data. We've got, all of his insider trading data at, Tesla. He's on the board of directors. And then we can break down the data into, start to bifurcate it into sales via 10b5-1 plans and sales that are not via 10b5-1 plans. And we found them, one set of sales is not predictive while the other is. It's those are the type of things when we see these changes in behaviors or the repeat behaviors that have proved, to be predictive, that really pay off. So.
I mean, it makes sense. You'd imagine that he's a lot less careful, just given that he's not such a high-profile person, and yet he still has a ton of access to his brother. So in these situations where trying to find, almost like the weak link, it's not that the main person is not going to be that careless, but there are people around them that might be, and you're looking for those kinds of signals. So that's fascinating.
Well, I mean, that's the thing. It's if we're working at insiders, like it's a group of people, and so when you break it down to data, you can get a lot out of it, right? I can do it blind without knowing who the person is, right? I can identify somebody who's made good trades. Right. I didn't need to know that Kimball Musk is Elon Musk's brother. Didn't need to know that he's a director and not, a VP there. Wouldn't matter. I could just look at the data from his trades and know, when he does this, it's good. But if I'm trying to piece together bigger decision making, because it's not that he doesn't have 100 trades like that. He's got 4, or 5, right? Now, that's enough for me from a quantitative point of view to say it's important and the data backs it up. If you're a quant, it might not be as important. So because the less data points there. So, but this human element and this behavioral thing comes in when I say, well, who are these people? How do I connect the data to the people? And so one of the things we're seeing now and that I'm looking at is, so if I'm seeing somebody buying or selling stock and they have a business that is levered to the federal government. So there's a lot of federal, there's a nice crop of federal contractors that are public companies like Booz Allen and Palantir talked about, Leidos, Kratos, Defense, things like that. I want to understand, what are their connections to the current administration? Things like that. So, are they allies of the current administration or are they not? Because, for example, Microsoft is on the outs with the current administration. And, nobody's noticed. Microsoft's getting no love. They're not getting hate, but they're not getting any love. They're not involved in anything going on, very much. Whereas Oracle, where Larry Ellison, was a, donor, to Trump, and for years has been, talking about things like a national ID, which sort of aligns with the current administration, or they're getting, more love, so to say publicly, and obviously companies like Tesla. So we start to look at the intersection of the data. Well, this person's buying stock. Well, who are they? And what, with all the things going on, sort of all this uncertainty, what are their sort of DC insider connections here? So we saw an example recently with somebody, he had been the CEO of Amtrak, a national rail company during the first Trump administration. So I started looking and I said, well, he's buying stock in a defense contractor and, where he's on the board. And I said, well, does he have a positive relationship with the president or does he have a negative? Because that really matters right now. It's mattered under past administrations also. It's a little more obvious now, but it has mattered under past administrations as well. It's been no secret about that. So we looked at, we started looking at things like that. There's, again, the intersection of data, these, with the individuals themselves. So, and again, I think that's where, that's where we kind of win is by, connecting the data with these other qualitative things. And then, our clients, whether they're quants or fundamentals, they run their own process, and use it.
Talk a little bit more about the product itself. And you mentioned there's data, there's a qualitative piece. What do clients actually log into, how they consume your data and research?
Yeah, so we have a very robust platform. Basically it's like a lot of investment platforms. You log in, it's kind of ticker centric. You pop in a ticker. So if I want to pop in Tesla, it'll take me to an area and it's all about Tesla, and it's going to show me the insider trading history there, stock buyback history, all their management changes. It's going to show me all their stock-based grants. It's going to show me all of their all the institutional investor disclosures. So institutional investors, have to make quarterly disclosures or sometimes more frequent depending on how much of a company they own. And so we collect all that data. So you can go and say, okay, who owns Tesla? What hedge funds own Tesla? What mutual funds, who's moving in and out of the stock, that type of thing. So, we have a very robust platform that also, and then we have the entirety of the SEC filing data, set. So every SEC filing that's made, and then we have a lot of different overlays. So when we look at things in the annual reports, 10Ks and then quarterly reports, 10Qs, so sections on risk factors. And so we help, our clients identify the changes in those risk factors. And, we also use things like Jacquard scores to look at the verbiage in the filings and what words are being used more now than they were in the past. And so we start to look at things like, changes in language and things like that. So the platform's like very robust in that you get a lot of data out of it. And you can, as a customer, you can export some of the data and play around with it how you want, utilize it in your process. You can use it for quick check-ins. You can use it for deep research, that type of thing. And then you can also use it to, analyze the SEC filings themselves. We do AI transcript analysis. We're adding AI employment agreement analysis very shortly. And then there's all these data, databases, incentive comp databases. We have IPO lockup databases, which are very important. So we have clients utilizing those in a data feed setting to understand potential overhang on stock as IPO lockups, are ending, and how much stock is being unlocked. Are there special things in the lockup agreements that potentially will unlock more or less shares, like thresholds that need to be hit? A lot of the IPOs we've seen in the last 6 or 7 years, they'll have multiple lockups where on this date, 80% of the shares that are locked up will become available. However, if the stock price appreciates 75% between the IPO, say in the first 90 days, those shares are going to come unlocked earlier, right? So, we have, this IPO database, buybacks, ATMs, things like that. So we've got the whole platform. It's basically self-service, do what you want. My team also layers on the research aspect of it. So we write about insider trading, we write about buybacks, we write about ATMs, we write about the stock-based comp. And what we're trying to identify for our clients there are, again, things that are statistically, data-driven, meaningful. things that we qualitatively believe are meaningful. And then, we look, obviously we look for outliers, we look for repeated or, or unusual behaviors. So as part of that platform, we have a series of what we call unusual events, which are things like the cessation of selling, where we're identifying this behavioral change on a company level. It also could be like very, very granular transactional level to identify things like when insiders are selling stock options that have a very long life, say 5 or more years to expiration, but they're getting a small gain on it. Say they're getting a less than 20% gain, because that's negative behavior. And so we identify, we use the unusual events to identify that. So we have the whole platform. Then we have the data feed. So the platform was, me and my team, we're the super users of the platform. So in one sense, we've architected the platform to basically wring as much value for heavy, deep research nerds, out of it. And then we'll distill it down into words. And if you just want to read our words and get it that way, but if you want the data, well, we've gone and we've built these, deep databases that have a lot of human intervention to ensure that the data is clean. And so, when we sell our product, it could be platform, it could be data feeds. We also have a research management system. So it could be a whole combination of things where you're organizing your internal workflow of research, within our software. And then separately, you're also using our platform to generate ideas or do risk management, or you're using our data feeds to plug it into, models.
It's in terms of customer base, do you guys skew mostly quant or mostly fundamental? It sounds like you have products for both.
It's, our quant business is our data feeds have really come online in the last couple of years. So we're certainly seeing that increase as it's becoming a more substantial part of our business, pretty much, every month. So, it's still, if I, look at, where we generate our revenues from, it's still more on the fundamental side, but, we've put in a lot of time and effort on the data feeds, doing things like, point in time, is can be difficult with some of these data sets. The biggest thing for us, with being for us as an organization to be comfortable, some of the quants, is just the investment we've put in to make sure that the data sets are clean and accurate, and the data sets we often, the insider data sets, our biggest data set, although the comp data set will probably sort of just from the amount of actual terabytes might take that over at some point. But the way that data is disclosed, there's a lot of nuance to it, and there's a lot of potential for mistakes. And so we have to clean it. There's an example I saw yesterday. Somebody, they filled out their Form 4, which again is what you disclose an insider transaction on. It's a filing you make with the SEC. And on that filing, they had 12 different transactions, and 11 of them were sales. One of them was marked by the filer as a purchase. Well, I know that's wrong. Okay. I know it's wrong for a number of reasons. I know it's wrong because they're not going to buy and sell in the same day, not when there's 12 transactions. I know it's wrong because the change in holdings was a negative change from the transaction, not a positive. No, it's wrong for a number of reasons. Well, unless the company changes that filing, other data providers are going to have that transaction as a purchase because they don't put the resources towards the human intervention. And that's fine. I mean, if you're Bloomberg, you've got so much data. I mean, the amount of derivative data they're dealing with is, just gigantic, right? But they don't, we specialize in this. So I'm sitting there looking at it, and it gets flagged by our system because we built flags. We said, we know it's not normal to have purchases and sales reported on the same Form 4. Right? That somebody doesn't, insiders generally don't buy or sell stock on the same day. There's actually rules against you can't do it profitably. There's a rule against it. So we flag those, and we have a human look at it. And then, we use our institutionalized knowledge and say, is this a sale? And we'll contact the company, and there's a lot of, we've had a lot of the contact we've had with the companies themselves result in a lot of amended filings. We'll say, you filed this, I think it's wrong. And they're like, yep, you're right, it was wrong. We're going to, file an amended Form 4. So, for us, the data aspect of it, without this human element is, to me, it's impossible because every day I get notes from clients saying, I saw this somewhere else, right? And it's telling me that it's a sale. And I can't imagine the CEO selling the stock right now. Like, why is it selling? I said, well, it's not a sale. It's a non-discretionary tax withholding. So I said, in this case, it's not even a sale. It's like the company withheld delivery of some of the shares and applied the value to the tax liability, right? So there's no cash generated. But if you're looking other service providers, they're using the term disposition. Well, and that's fine, that's true. But they use the same term when somebody actually sells stock. So how, if you're getting data from this, you're looking at a screen, you're getting it in a data feed, how do you differentiate it? How do you know whether that's a sale? And if it's not a sale, and you've got hundreds of thousands of these transactions in a data feed of insider selling and they shouldn't be there, you're going to make bad decisions. You're using bad data. So that's why, for us, we spend so much time on making sure that the data is proper, because also as an analyst writing about all this and trying to deliver ideas and risk management solutions to our clients, if the data I'm looking at is wrong, obviously the data they're looking at is wrong, but I'm making bad decisions. So, what the nice thing is for me, again, in my team, we've been here so long, where this is, we're experts in this. I don't think anybody has looked at in the entire world more insider trades than us, because we've been doing it so long. It's like, it's imperative that the data be,
I totally agree. And I think it's very underrated, especially for some of the investors that don't actually spend the time to look into the data, nor should they, but just the realization that just like it takes a lot of time, energy, and effort to understand a company, it's the same thing with the data set. These things are living organisms. They change all the time. People create them. They have different incentives when they're creating them. All these things cause biases. And unless you can spend your entire career, your life looking at these data sets, and you'll always find something new, no matter how common or niche the data set is. And I think that speaks to the testament. Like, yeah, people assume that you want to start a data company and, it's really easy because I can just find some data and resell it. But the reality is, like, sure. But what I like to tell clients and investors is that data is useful when it's showing you an outlier, when it is diverging from consensus by definition. Because if it's something everyone else already knew, it's not interesting. It's only interesting if it's different. And that is exactly what you need to start asking yourself is, like, can I actually trust this? Is it real? Is it a fluke? And only by doing these kinds of things that you just described, Ben, can you actually get to the bottom of, okay, yeah, maybe this thing is real. Or here's all the things I tried as much stuff as I could, and I still can't find anything wrong with it. So I'm going to assume that it's most likely a real outlier. So yeah, it's like when you need data the most is when you actually want people that spend a lot of time understanding the data, understanding the nuances, so that they can explain to you why they believe it to be correct.
Yeah, and absent that, you're prey to falling into a really big trap of bad decision making, not just for an organization like buying bad data, right? But if it's going to infect your investment process, I mean, that's a real problem, and we see that, and again, we try to, my goal is to get people using good data and to get them using it, our good data in their process, for them to find value of it, and also find value in our methodology of how we collect and, structure and clean that data. Because I think for us, once we get some buy-in there on the customer end, and then we get that trust, that's how we've maintained relationships for so long with so many of our customers.
Yeah.
I mean, and your there's so much garbage in and garbage out with data that, I mean, this is the biggest problem with AI right now, is the garbage in, garbage out aspect of it, is just that, if you're putting in, got to make sure your inputs, whether it's your prompts, whether it's your text that you're putting in, whether it's your data, that all has to be good, because if you don't, then you're just going to get garbage back on it. And we've seen that, so many times. And we spent a long time, like, on our transcript stuff, and we put it up against bigger companies doing it, talk to our clients and, say, well, if you don't have an expertise in understanding earnings conference calls and, like, how they're run, then how can you write a prompt to get AI to do something? Because you can't just say, AI, you're super smart and you're like a Wall Street analyst, do this for me. You got to do some handholding, That's why I always see AI is somebody who's incredibly intelligent, right? But they're really not an expert in everything because there's too much nuance involved with so many aspects. There's too many human elements and observational things that you need to tell it that. And if you don't have somebody who knows that to tell it that, then you're not going to, get that value out.
Yeah, I think now more than ever, English majors are going to have an advantage with the prompt engineering. Communicating clearly, expressing what you're ultimately trying to get at is very underrated.
Yeah, I mean, it's funny because as technology moves on, and the prompt engineer, it was 5 years ago, it was the data scientist. Everybody become a data scientist, become a data scientist. Well, prompt engineer is probably a little easier in one respect. Yeah, less math involved, right? So, but data scientists are important and will continue to be. It's going to be, I tell you what, there's going to be a lot of interesting things going on in the data sphere within the next year because of the things going on with the government, because you have an enormous amount of brain power that is being sucked out of the public sector and is going to be looking for jobs in the private sector, right? Because they're going to need to. I mean, you have people who have been dealing with really deep and complicated data analysis for years, in giant data sets, and they really understand how to identify trends and outliers and, actionable items from these data sets. And they're losing their jobs right now. And they're going to be out there looking for jobs. Now, the flip side of that is with less funding going to a lot of universities, there's going to be less research. So you're going to have a more privatized data. So, when we think about things like this SSRN, this repository of academic research, one has to suspect that you're going to have a less publicly available academic research because there's just not going to be the money for it. And there's not going to be the resources for it because that's the way, that's sort of what we're headed towards. There is going to be a void. That void is going to be, fulfilled in the private sector. That's sort of the purpose of what they're doing, what they're trying to do with the cuts to the government thing. Agree or disagree with it, doesn't matter. That's where we're headed. When we think about the cuts at NOAA and the National Weather Service, that's data. Farmers need that data. People need that data to make decisions. Somebody will step in and provide that data, and they will charge for it. So all the data that the government's doing, that data, will be filled. And what you hope, again, is that you have people who are well-versed in that data, because all of this is creating opportunity, just like our opportunity came because of a regulatory change, which was to increase transparency, right? That when SEC at the time wanted to increase transparency. So that helped us. That helped create our business. Let's put it that way. There's things that are going to become less transparent. That creates opportunity, but are you going to trust that data when there's less transparency, with it? So it's a really interesting time for data and data scientists and sort of, and where this is going to move to because of the levers being pulled at like the government level. And, it's going to be really interesting to see sort of, how this plays out, with, in an investing realm. Like, do we have access to more data in the near term or less data? Now, the SEC already made one change. They were going to put out some short data starting in February of this year, and they pushed it back a year. Now, they pushed it back saying that they didn't feel like there was enough time for the funds that have to report their short data to actually get it together. I don't know. I'm going to say I think they did have enough time. I think that this will probably be something where it just gets kicked. It's just, they just kill the regulation because and this happens with changes in administration. But that was some data people were waiting. Oh, this is going to help me understand short interest flow, and things like, some things that I'm not getting from the currently available short interest. So there's a potential for a regulatory change that at first was going to bring us that transparency, but now there's a potential it might just never happen. For me, we were planning for that, but we didn't plan a lot because I said I need to see what it looks like first and if it's actually going to happen. So I didn't want to put a lot of resources towards it. So, I was like 100% sure it's going to happen.
Yeah, that just underscores how much this is constantly evolving, and you need to adapt and you need to understand a lot of different things from government changes, regulatory changes, obviously data changes in order to make a difference there. Well, Ben, we're coming up on time. I do have one last question for you, which is I'm curious about you're very early on in newsletters. I have friends who are just now starting investment newsletters. Do you think that is a futile endeavor, or is there still something to be said out there? Has everything already been said?
Things like Substack now, which makes delivery a lot easier and getting payment for it. I think there is a market. I think the issue is this is if you want to make, there's two ways to make real money in like the investment newsletter sphere. One is get a lot of retail investors, right? And so you could figure out how do I attract retail investors, right? And is it by being super, super honest, or is it by being sensational? Is it, however way you want to do it? That's one way to do it. If you want to attract real money, because there's too many opportunities for, back in the day, like there's companies like Motley Fool who really dominated the newsletter, like investment newsletter business for several years. Now it's too easy. Any mom and pop, anybody can set it up. Any wannabe analysts who's seeking alpha or Substack, whatever it may be. The other way is to obviously sell to institutional investors, right? People who are actually willing to pay you real money for, at its, big chunk of money, whatever it may be. And the way to reach them, through investment newsletters is through things like the things we're doing. It's like differentiated ideas. Nobody at a hedge fund is going to pay to read somebody else's fundamental analysis. Like I don't care what you think of, CarMax because you've crunched the numbers yourself. Like you're not going to tell me anything new. If I'm an analyst at a hedge fund, I've got access to sell side reports. I've got an ego and that kind of thing. So it's really, again, how I made my sort of bones was I found information and data that other people weren't finding. And that's how you make money. I mean, that is always, you could either lowest common denominator, play to the crowd, and then that's a volume business, whatever it may be, or you can sort of aim for something more sophisticated and value to a smaller audience that really knows how to utilize it. And that ultimately, it's harder to execute on that wider shotgun blast of like trying to get a bunch of retail investors to pay you money. It's harder to make connections within the institutional sphere, but it's a lot easier now. I mean, I've seen people, they started Twitter accounts, and which is exactly what I did. I mean, it's exactly what I did, 20 something years ago before Twitter. Again, a similar service. I started an account and I was documenting, somebody told me this company's going to shut down or lay off 50 people. And then people start feeding me information. Well, nowadays it's the same thing. I mean, if you're sitting there and you got a nice Twitter account where you're blasting out interesting things, or you got a Substack, whatever it may be, people are going to start, people want outlets for information also. Because I might have information, but I might not necessarily want to put my name to it for whatever reason. This person knows this company. They understand what's going on here. I'm going to give them some information. So, I would suggest someone wants to get into the newsletter business, find some areas of focus that you can be an expert in, bring something different because your fundamental analysis is not going to be as good as the people already being paid for it. And if you want to do fundamental analysis, go try to work for a hedge fund anyway, right? And look at the alternative data sets and look at some other ways to sort of generate investment ideas or risk management ideas. And again, I mean, this is what we do. We don't, all these years we could have done things with fundamental data, and we just don't. We've just never been interested in it. And it's nice as our clients know that also. So if I write about a company, I'm writing about insider buying or selling, they don't come to me and say, but the margins and this and that. They're like, I know what the margins are. I'm taking what they're telling me or what the data is telling me, putting it up against what I already know. And I don't need to get into a conversation or argument by saying, well, they're buying, but their margins suck. It doesn't matter. My end, they're buying. And what I'm trying to tell you is in the past, when they bought, it means X, Y, Z.
If you're trying to sell your newsletter to institutional investors, what do you think there still is a role for Twitter? Do you believe in these like freemium models where you make some version of the newsletter publicly available for free and then you charge for some, or do you think it's a much more targeted sales process where you reach out to these institutions directly and just sell them on your paid newsletter?
I think Twitter's good for marketing. It's not good for distribution. Twitter, has turned into a really awful venue to get good information, in my opinion. I just think that you've had a brain drain, and it's so swamped with politics that it's just really hard to find good information. I think that the way to do things is you sort of got to start small. You got to start with, if you have connections, utilize the connections. If you're sort of coming at it from, not being connected to the industry, you kind of got to start free and market it. But things can turn very quickly in your favor. So what happened with me years ago was I was doing this thing, and again, it was like, again, just Twitter before Twitter. And I'm blasting out these things to a group of people who are all in the .com industry in New York and Silicon Valley and, Texas and things like that. And, 4 or 5 times a day, I'm like, oh, I heard so-and-so's laying off people. I got confirmation this. And then what happened was I got word that Amazon was going to do their first ever layoff. And do this thing. And then a couple media outlets called Amazon, and they're like, who is this guy? Some dude on some service we've never heard of saying this. And then 2 days later, they announced exactly what I said they would. 2 days after that, I'm featured in the Wall Street Journal, right? So it's sort of like, and then all of a sudden I have people, wait a minute, this guy's breaking stories that I need to know about, or he's got information. And I think that happens. I've seen it happen with people, some of the people like we read, it's like, hey, this came to my attention because they got something right. And that's the thing. I mean, that's at the end of the day, if you're not right more often than you're wrong, nobody wants to pay you anything. And so break into that. It's come at it differently. But also, I mean, look, there's so many networking opportunities now relative to 20 years ago or even 5 years ago. I mean, I think people should be using LinkedIn, as distribution and also connection making, again, X, Blue Sky, whatever social networks, people want to use, start a Substack, start it free and then as you start getting an audience and start really, getting some wins, that's when you start to charge money. It's hard if you don't have any track record. Hopefully if I had to go launch a Substack, I have a track record I can market on. If you don't, then you really gotta you gotta bring some wins to the table pretty quickly.
Yeah, I love it. Thank you. Well, Ben, yeah, it was a pleasure chatting with you and learning about what what you've been doing in your career journey. So thank you for joining me here.
I appreciate it. It's a lot of fun.